Hello, everyone. Welcome to the Safe House, brought to you by the Safe House Initiative. I'm Jeff Edwards, co-chair of the Safe House Initiative, and your host for today's podcast. Cyber insurance is becoming more and more difficult to get without good cyber hygiene. This has driven the fusion of technology and cyber insurance. This is rapidly evolving and is being addressed by visionaries like our guest today, Gordon Malin, co-founder and CEO of Elpha Secure. Gordon, welcome to the Safe House.
Thanks, Jeff. Pleasure to be here.
Well, Gordon, welcome to the show, first time. And why don't you introduce yourself to our audience? Kind of, tell them about the Gordon Malin story, how you got to where you are. From the time you were born, or maybe a little bit after, would be a good start.
How much time do we have? No.
That's
No,
right.
pleasure. Well, no, listen, I think I'll take a little trip back in time, and I won't go all the way back, but it's interesting kind of how I got into insurance, and then I'll transition that into how I got into insurance plus cybersecurity. But going back, about 20 plus years now, out of college, spent a few years consulting. That's not interesting. I won't take too much time talking about that. But during that period of time, it's kind of like sliding doors. I missed a train. I was coming up from Connecticut back into the city, and I missed a train, which was annoying because anyone that commutes from Connecticut to the city, you realize the next one's about a half-hour wait. So get on the next one. It's pretty crowded. It was around the holiday time, and then sit down, and then I'm sitting next to a lady. Her husband became a friend of mine, and I started seeking some career advice from him. And he said, "Oh, you should talk to my friend. He runs a hedge fund. They just moved from Philadelphia down to St. Croix in the Virgin Islands. They're looking for, someone young and hungry to be essentially their eyes and ears and an analyst in New York City." And I was like, sign me up. That sounds amazing. So I met with I met with them, and we had a nice conversation, got a job offer. And now I'm really excited because now I'm working for a hedge fund. I'm 25 years old, going to St. Croix, once a quarter for a few weeks. Like it was pretty good. I wasn't making any money, but it was pretty good. And long story short, about 3 months into my tenure there, I was training to be a banks analyst because they were a banks fund. They decided to broaden their mandate to broader financial services, and insurance being one of the next largest asset classes. They basically asked around, all right, we want to start covering insurance. Who wants to be the insurance analyst? And I'm looking around. I'm looking at being the number 5th bank analyst or the first insurance analyst and only insurance analyst at the fund. So kind of raised my hand, and I'm like, I'm it. I'll do it. And this was the beginning of 2005. So I started teaching myself insurance. And then in 2005, if you recall, was when Katrina, then Rita, and Wilma all came in. So it was pretty much a seminal year for the insurance industry. And to the point where companies were blowing up, right? The losses were so massive. It was an unexpected loss. The storm surge, the flooding. I mean, the devastation was so much more than what anyone had predicted, that companies were doing capital raises, going insolvent. And that was a really exciting time to learn insurance, because you're actually watching, the efficacy of the insurance ecosystem and what it's really there for, right? To be there to support people in a time of need. But they didn't realize how much they had to support people in a time of need, which led to a big change in the insurance ecosystem. There was a number of capital raises, a number of things called sidecars. I won't go into a rabbit hole there that came up. And it was just a really fascinating time. And I learned a lot in a very, very short amount of time about the insurance.
So it was a stress test for the entire industry.
It was a stress test. Yeah. In fact, I would encourage anyone listening. There is an article written by Michael Lewis in 2007 called Nature's Casino. Google it. You'll find it, read it. It's written about 2 people, John So, who was one of the first investors and really probably the father of the ILS world, insurance-linked securities, cat bonds, and Karen Clark, who was one of the first modelers of catastrophe risk, all for property risk. And when you're reading that article, which is a fascinating read, and you'll enjoy every minute of it.
And Gordon, I did read it, and it is fascinating. It reads like a novel. It does.
Yeah, I gave Jeff some homework before this to do. And he obliged.
He's a very tough guest, folks. So he gives homework and everything else. Very demanding, but well worth the while.
As a must read for anyone. But when you're reading it, replace property, hurricanes and think cyber. Think cyber risk, think systemic risk, think of a large cloud outage, think of an operating system shutting down. And when you think through that article through the lens of cyber, some of the pieces will start to come together of what Jeff and I are about to talk about today. But I would encourage everyone to read it. So fast forward, I spent near 20 years as an analyst covering insurance and then a portfolio manager. Became a portfolio manager in 2010, joined an organization, SAC at the time, now .72. So if you're a Mets fan out there, I worked for Steve Cohen for a number of years. I had a phenomenal time there. In fact, one of the most fun parts of that job was SAC started a reinsurance company, and I spent a lot of time helping them think through that strategically. Myself and one of the other analysts there were the only two people in those four walls who really knew the insurance world. So we helped build a reinsurance company for Steve Cohen, and that was a real pleasure. That was a lot of fun, and it was an amazing experience there. Fast forward, 2017, started my own fund called Mountain Road Advisors. Also spent some time at Citadel through that period. And then, through my entire life as being a portfolio manager dedicated to the global property and casualty insurance space, and then my previous life as an analyst dedicated to the space, I got to watch essentially the cyber insurance line of business really grow up. I mean, it's about a 25-year-old product, a little older at this point, and watching it go from zero to, even in 2016, 17, it was $1.5 billion premium lines, very small when you compare it to today. We're probably sitting at 16, 17 billion of global premium. But it always interested me because it struck me that the global digitalization that everyone was going through on a global basis, all the way down to Main Street. Essentially, think about that, the risk surface, security speak, the attack surface, in insurance speak, the loss content was only going to increase, and it was going to increase exponentially. Think about as Main Street moves from brick and mortar to laptops, right? So cyber insurance was going to be one of those insurance coverages that was going to go from being a luxury product back in 15, 16, 17 to compulsory. Everyone, whether you're a small business, whether you're a plumber or a contractor, or a small law firm, all the way up to the large corporates who obviously spend a lot of money, time, and resources on cybersecurity and cyber insurance, everyone was going to need this product. So that got me thinking about where cyber insurance was going to head. And
what year was that, Gordon? What year you started to think like that?
This was about 2018.
18?
About 2018. Okay. And what dawned on me too, going back to Nature's Casino and catastrophe risk, what you realized was in cyber, everyone uses the same operating systems, the same cloud providers, the same applications, the same ubiquitous software, the same CRMs, the same, et cetera, et cetera, et cetera. And that was only going to get worse because of scale and market share growth of essentially the tech industry winners. And so what that was going to do was fundamentally create a much larger tail than any other line of business, even property catastrophe, over time at maturity. And so when you kind of do the math and the fundamental kind of structure of the marketplace, what you realize is the global P&C balance sheet. So in the aggregate, add up every company from AIG to Zurich to AXA to Allianz, all the way down to the small ones. What you realize is they only have so much supply of cyber catastrophe capacity that they could put into the market. And so we're not and I would argue we're not actually terribly far from hitting that level of finite supply. I think we're probably a few years out from it. But what that means is that you get to a point where there is a supply demand imbalance, And, think about the demand. That's just your Main Street business who is buying cyber insurance, probably for the first time. Think about
Yeah.
the penetration rates in the US, which is probably the most evolved from a cyber insurance marketplace. US
Yeah.
penetration of small businesses who are buying a standalone cyber policy is less than 10%. I'd say it's probably around 6 or 7%. Go
So
ahead.
Gordon, why is that? Just curious. Why is the
So
penetration so low? I mean, it's shocking, actually.
it is shocking. So some people have some coverage. Probably 30% of small businesses have some small level of cyber insurance coverage. It doesn't cover
Okay.
everything they need it to, but they
Mhm.
get that through their BOP, their business owner's policy, or their commercial package policy, which is
Got it.
basically your entry level product if you're a small business. It covers your general liability, your workers' comp, your property, and you get a
Mhm.
little bit of cyber thrown in. You might have
Mhm.
$100,000 of limit for a few coverages. So people either think that they're covered, a third of the small business think they're covered because they have the BOP endorsement, and to some extent they are, or they don't think they have any risks. They don't think that they're actually exposed to the threat actors and what's actually happening. Like, it's not going to happen to me. Who cares about me? They're going after, the large corporates where they could actually steal a lot of money, steal a lot of data, but wrong. They're going after everyone and anyone, and small businesses are
Yep.
as exposed to the threat actors as any large corporation. And quite honestly, they don't have the defenses in place to even protect themselves, right? So
Yeah.
you can start to see where this is going. So the penetration is very low, and as that grows and we move from it being what I would say a luxury product into a compulsory product, and a lot of time that compulsory need is driven by a contract. You have a commercial contract, there's any sort of
Yep.
data exchange, you're a software company, like you're getting personal information back and forth. A
Yeah.
lot of times, if you're working with a larger organization, they're going to mandate in the contract that you have $1 million of cyber limit, because they want you to be protected and be able to have, response, recovery. And if they don't want the liability of having someone in their supply chain that's
Yeah.
unprotected. So
Yeah.
there's a lot of forced demand. We love forced demand. Forced demand is a beautiful thing. And there's
Yeah.
finite supply. So forced demand, finite supply. And when you put that all together, what you realize is that at some point, there's not enough supply in the system to meet the demand. Again, I think we're a few years away from that. But when we get there, what that ultimately means is, from the insurance perspective, the most lines of business and insurance spend spend most of their time as price takers. Basically,
Yeah.
there's a market price, it's competitive. People are continuously trying to grow market share. So rates keep going lower. People throw in more coverage to win business. Then all of a sudden people realize they've underpriced the risk. They've put in too much coverage. There's this shock loss somewhere in the system. And then you get what's called a hard market insurance. And in cyber, we saw this in 2020 and 21 on the back of the ransomware epidemic. You get a shock loss. The insurance market throws up their arms, re-underwrites, and what that technically means is we double rates, we triple rates, we cut coverage, and we basically try to get back on sides of the profit margin equation, right? And so, what that means, when you, from a cyber insurance perspective, when you get to a point of a supply demand imbalance where there's more demand than supply, you
Yeah.
functionally become a price maker. So you actually don't the typical cycles that most other lines of business live in, where you might have 17 years of a soft market and 3 years of a soft market. We
Yeah.
will get to a place in cyber insurance where you have a perpetual firm market. And that is a wonderful place to be. There has never been a line of business in insurance where that has happened. So in 2018, I was sitting down with my co-founder, and we began to kind of, as I just kind of went through all the kind of the structural elements that we were thinking about the supply side. We also realized the way to get the data to manage PMLs was also the same thing that was going to stop attritional loss. But we realized in EDR, those are pretty expensive for small businesses. So what if we build our own? And what if we began to build our own proprietary software that we could sell, or not sell, that we could, what if we began to build our own proprietary software that we could embed into the insurance premium and the insurance product, and give small businesses the insurance coverage that they need, as well as the security tools that they need, all in one package. So we began to kind of iterate on that, and that was really the foundation of Elpha. So we're building that, and then all of a sudden, the ransomware epidemic, starts to pick up in 2020 as
Yeah.
COVID hits, and we're
Mm.
sitting there going, "Oh my gosh, we've built our first two products were backup and MFA," and that was the first thing that the insurance carriers were
Oh,
essentially like responded to from a re-underwriting process, and we're sitting there
yeah.
going, "We've built those, we've built those."
Yeah.
And that enabled us to begin to have some conversations with what are now our core strategic partners and investors, to
Mm.
really about let's build a product that truly integrates cybersecurity into the cyber insurance. And
Yeah.
that was really the foundation of Alpha.
Yeah, and that's why you're viewed as a visionary in this particular segment. So, and really, that's brilliant.
Visionary that's very kind words. I've just as I said before, I've seen this movie before. Anyone in
Yeah.
insurance has seen this movie before if you've watched the evolution of property. And it's been fun. It's been fun.
Oh, oh shucks, I'm just a man, put my pants on just like everybody else. I heard that one. No. So to create supply, how do you do that? How do you create? Do you then reduce risk to get to the supply? And that's where the technology is starting to be embraced harder with the insurance policies. Is that what's happening? In the I've heard InsureSec
Yep.
is a term. So can you kind of tease through that and kind of help us understand a bit more?
Absolutely. So if you're an insurance carrier, and you write cyber insurance, what happened in 2020, 21 off the back of the ransomware epidemic, and ransomware was already in motion as an issue, but COVID and work from home really
Yeah.
exacerbated the problem.
Yeah.
And so what that very quickly hardened the market for the cyber insurance carriers because they started to suffer a lot more losses than they expected.
Mm,
And
mm,
so they instantly went into this re-underwriting mode, raised rates, cut terms and conditions. And what they did is they also then began to require controls, cybersecurity controls.
mhm.
Think backups, think multi-factor authentication, think EDR, think email security, right? And
Yeah.
so what happened was they basically started to say, no backups, no MFA, no insurance. Now, rewind 2 years prior in 2018, 2019, to buy a
Yeah.
cyber insurance policy, literally all you needed was a pulse. And it was being given away and you're getting all the coverage. And to be
Yeah.
fair, though, it was still a profitable line of business. They could give it away until the ransomware shock happened. So this notion of controls and cyber insurers beginning to force controls on insureds if they were going to be able to have continuous access to the insurance market, um, quickly basically began to drive, I would say, businesses like ourselves, other
Yeah.
InsureSec, other cyber carriers, traditional carriers as well, to begin to think about how do we integrate cybersecurity into
Mm,
the insurance product, or how do we leverage
mm,
cybersecurity and basically have a better outcome, right? And so
mm.
what we did from a business model perspective, it's not terribly complicated. You go and look at what's causing losses, right?
Yeah.
What's driving what we call incidents in
Mhm.
security speak, or frequency in insurance speak. What drives frequency losses, right?
Mhm.
Back then it was open RDP ports. Like 60% of ransomware events were driven by open RDP ports. Bad guy brute forcing a weak password with no MFA on it, right? So what
Mm,
do? You put MFA on the RDP port, and all of a sudden you've eradicated like 60% of your ransomware frequency.
mm.
Backups, they actually do get through the RDP port or through into the system in any other way, and they ransom you. Well, if you have a backup, you don't need to pay the ransom because you could restore from backup and carry on, right? So backups, MFA became two of the basics very
Mm,
quickly in
mhm,
2021. And then as you mature as an organization, things like email security,
mhm,
EDR become the very
mhm,
obvious controls because they're the ones
mhm.
that significantly reduce loss content. You have an
Yeah.
EDR in place, malware is not going to get into your system, right? You have email security in place.
Oh,
If you click on the phishing link, it's going to get quarantined, or it's going to be filtered before it even reaches your inbox, right? So the notion of basic level of security posture and hygiene from an insurance perspective was very powerful because it massively reduced frequency incidents occurring, as well as the severity. If you do have an incident, how expensive is it to recover? Was there a lot of, PII, personal information that was exfilled and is threatened to be published on the web? Do you need to send notifications out? Is that going to create litigation? A plaintiff's bar is going to get involved, and there's health records now, and then they're going to sue you, and that's going to result in a much larger, a more severe claim, a more costly claim. So the more controls you have in place, the more you could actually bend the loss curve and reduce loss content. Insurance, we call it loss ratio. Loss ratio is the numerator is, claims dollars paid, and the denominator is premium collected, right? So you're constantly trying to reduce your loss ratio. And what I just described there was essentially what we refer to in insurance as attritional losses. So losses that happen to a single entity, right? Happen to a single corporation, a single small business. Those are attritional losses. And as an industry, you could wrap an insurance industry, you could wrap your arms around that. You could price for that. You could require controls for that. You could, reduce coverage, for it. There's lots of kind of tricks you can do from an insurance perspective to make sure you're on the right side of that loss ratio conversation.
Because there's lots of those. I mean, because you have a whole pool. There's millions of those to pick from, right?
All the time. Yeah. Average frequency, if it's low single digits, low to mid single digits. So, the odds of any single person having an incident in a given year, is probably, I don't know, upwards of 1 in 20. So if you're listening and, guaranteed sometime in your career, and if you have a long career, probably 2 times in your career, your corporation is going to have an incident, going to have a cyber insurance incident. So those are attritional losses, and we can constantly price and adjust price and kind of stay on the right side of that. The biggest issue for cyber insurance, though, is that systemic risk, that catastrophe exposure. That's where the cyber insurance ecosystem is spending a lot of time thinking about and thinking through. And that's where, to your earlier question, we've spent a ton of time thinking about that, because to your earlier point of how do you create supply, that's the holy grail. How do you create supply, right? So how do you create supply in cyber insurance? By managing your tail risk, we have this thing called PMLs, probable maximum losses, and we do it in return periods. So I would say almost every insurance company, barring some, but most every insurance company globally is essentially calibrating their capital to the 1 in 100 Miami wind event. That is the peak peril from the insurance ecosystem's vantage point. In cyber, we're beginning to look at the 1 in 250, because the view is you got to look further out on the curve, because the frequency of a very, very large event is probably less than hurricanes, which happen very frequently. And we do the same thing with earthquakes, because they have it's a low frequency, but a very severe event. In earthquakes, we can calibrate to the 1 in 250. So the 1 in 250 seems to be where the cyber insurance industry is landing on. And so you're kind of measuring yourself to that. We call that the PML. So PMLs are beginning to become a thing that everyone is focused on. Right now, the notional premium and the notional PML for most carriers is still manageable, but for many carriers is beginning to become a peak peril. And so that fundamentally, going back to my earlier point, when cyber becomes a peak peril, you could no longer offer cyber insurance, or grow your cyber insurance book, I should say. You can maintain it, but you can't grow it because you're up against your risk tolerance from a capital perspective, because you need to be able to absorb a 1 in 250 event. You need to be able to absorb that event, only lose, roughly speaking, probably 15 to 20% of your capital, of your shareholders' equity. If you're a mutual, your surplus, if you're Lloyd's, your fund at Lloyd's. Those are basically the risk tolerances. So there's fundamentally an aggregate amount of limit or loss that any insurance organization is willing to stomach. And that's really your 1 in 250 cyber PML.
Join us next week as we continue our conversation around the InsureSec space as it's developing and growing and affected us all. For more information about the Safe House Initiative, please use your mobile device to scan the QR code on the screen, or send us an email at info@safehouseinitiative.org, or visit us on our website, safehouseinitiative.org. We look forward to hearing from you.